Hi there, welcome once again to Dukascopy TV. I'm Ben Jones. After 24 quarters without any growth, the next GDP release could finally show some growth for Greece. On the line to discuss this, I have Danae Kyriakopoulou from the Centre for Economics and Business Research. Danae, I'd like to get your initial reaction first to some of the data that's been released today. Unemployment now stands at 26.4% and the inflation rate is at minus 0.8%. Were you expecting figures like this?
Yeah, today's figures weren't any surprise. They largely fit with our short-term view of the Greek economy, and they are in line with the trend we've been seeing in the most recent months. So unemployment at 26.4 is an improvement from recent months, but it's not a dramatic one, and the rate in Greece is still more than double the Eurozone average. I would also say this is a structural feature, and it's likely to persist even as the economy starts to post positive growth. And I think what is more interesting is youth unemployment. This fell sharply to 51.5 in June, and this is the lowest we've seen in almost 3 years. Now, as for deflation, this was a worsening from August's figure, but I don't think deflation is the biggest worry. It is normal to have deflation in Greece as the country struggles to become more competitive in the monetary union, where the overall level of inflation is low. And the return to positive price growth hinges very much on external factors, and so this is not the most useful indicator for the health of the domestic economy.
Now, there's been talk that Greece could return to growth when the next GDP figures are released. Is this a possibility in your opinion? What's led to this, and how will it affect Greece?
Yes, this is quite possible. Although the economy shrank in Q2, the rate of decline at minus 0.3% was the lowest we had seen in 6 years. And the Q3 data are usually much rosier in Greece because of the boost from tourism in the summer months. And this year, tourist arrival numbers were very strong. And so I expect very strong GDP expansion in Q3. But this is a seasonal thing, and growth will not be as strong in Q4. So overall, in 2014, I think Greece will be on the verge of achieving positive growth. And even if it does, growth will be marginal.
So what impact will the ECB ABS programme have on the Greek economy?
Since the start of the crisis, the ECB has progressively reduced the quality of assets it says it will accept as collateral, and this includes ABS. But Greek ABS are unlikely to meet even such relaxed criteria. And in his latest press briefing, Draghi further relaxed the criteria by saying that ABS lower than investment grade could be purchased under certain conditions. And in as far as these certain conditions are accepted, then Greece would be the prime beneficiary. However, I don't think there will be sufficient support of a plan to buy Greek ABS. On the contrary, such an initiative, I think, is doomed to face substantial opposition, mainly from Germany. I think the biggest impact will be through the exchange rate channel, actually. If monetary easing by the ECB, be it through ABS or QE, manages to lead to a weaker euro, then this will help boost price pressures much more than the channel of lower nominal interest rates or supposedly increased lending.
And finally, what else could the ECB do to help support a recovery in Greece?
CEBR has consistently argued for outright quantitative easing, defined as the purchase of sovereign bonds. QE would help bring down long-term market interest rates, as it did in the US and the UK. However, even that may not be enough in the case of the Eurozone, where long-term market rates are not as important in influencing private sector behavior. In contrast to the US or the UK, which rely much more on markets to distribute capital, the Eurozone is very bank-centric, and this means that most investment is financed by bank loans, and these typically don't have very long maturities. So in the US, a much larger proportion is financed by bond issuance, which can have a larger maturity than bank loans. So lowering the long-term rates, which is what QE does, will have a much bigger effect in the US than in the Eurozone. In the Eurozone, the transmission from sovereign rates, and especially long-term rates, and the rates paid by households, such as mortgages, for example, is not as tight as it is in the US. So I think all this leaves us with a rather dismal conclusion, which is that monetary policy may not be enough in the end to fix the troubles of the Eurozone, and that this is a task too big for the ECB. There are limits to what the ECB can do, given its central objective, which is to maintain price stability. At the minute, the ECB is overactive, And this is partly in order to compensate for the complete inaction of fiscal policy. So the austerity culture that has been imposed on many of the periphery countries has removed any room for them to expand fiscal policy. And the countries that do have such room, such as Germany, for example, do not have the will to do so. So, for example, the coalition government in Germany has recently said that they're aiming to deliver a balanced budget next year. But I think in the end, as the impotency of monetary policy becomes more and more evident, the pressure to use fiscal tools will become too high to ignore.
Danae, thank you once again for joining us today. That's all from me for now. Stay tuned to Dukascopy TV for plenty more updates and exclusive interviews. Goodbye.